You're trading support and resistance wrong, and this is why you're losing trades like this. After this video, you will finally be able to trade support and resistance properly, with high accuracy and high win rates. It's not going to be easy as you expect, so take a seat and pay close attention. So as you probably know, these support and resistances are usually found in consolidating markets. They are markets that are essentially moving sideways and not clearly trending in any direction. The support is a level where the market hits multiple swing lows from where the market rejects to the upside each time the price hits the support, while the resistance is the opposite, being the level where the market rejects down from past highs. So the most simple strategy is to buy the support levels and sell into the resistance. But the problem is met when we have a breakout of one zone. For example here, a break of the resistance. What most traders do in this case is they buy the market on the breakout, with their stop losses near below the broken level. And the market most of the times move into their stop losses, taking their liquidity just to continue the break afterwards. So the question is, how can we stop that from happening? And also, how can we profit from this type of liquidity sweep? This is what we're going to learn now. A great solution is to implement market structure and price action into your trading plan. And if we analyze how highs and lows have formed, for example here we see that we're having an uptrend formation of higher highs and higher lows. Each time the past highs break, that's a formed break of structure. It just means that the market has a higher chance of continuing the type of price action that it's already been forming recently. And this being an uptrend, right? You can easily observe that by the swing level formations of higher highs and higher lows, just like I've said before. So being in an uptrend, we would expect for the price to not break past swing lows, because that would create lower lows, which would invalidate the uptrend. So basically these lows must be protected for this trend to continue. Notice how each low is higher than the previous one recently, and that is what we would expect to happen next. Basically to form a higher low that should get followed by a higher high, which would continue the constant bullish upwards break. So if we expect a higher low, meaning that we want to see the price near these lows again, we can look for a demand zone. It's the entry model we use on uptrends. For example, here we have one. This did not fill and moved into the break of structure, so it's not the highest quality one out there. There is also another demand above, but the same story with this one as well. And there is one last one here, with the price breaking out of the demand right now. And being the last one, this is the one that we're going to take. But we won't trade from this demand, and instead, we're going to zoom into a lower time frame, let's say the 5 minutes time frame. And we're going to look for another demand inside this lower time frame. This is a top-down analysis and refining the demands. We've made setups like this one in my channel, so we got to pull back, then quickly continue to the upside. So this is basically the uptrend formation of higher highs, higher lows, higher highs, with a break of structure that validates a demand. And a demand is found on the lower highs of an uptrending price action, and the exact zone should be on the last downside candle before the upside impulse started to happen, which is this candle right here. So this is the refined demand. Now, the setup positioning, buy long setup on the demand. Stop loss below the demand, and take profit above the swing highs. Why there? Because we're expecting trend continuation. So basically to confirm a higher high since this is an uptrend. And that was it. This time on the Nasdaq, we are on the 1 hour time frame. Here again, we see a consolidation, basically a market moving sideways. First, we zone out the support and resistance levels. The resistance is taken from where the swing highs started rejecting to the downside. So it's around this area. This is the resistance. And the support is the level where the swing lows started to reject to the upside. So around this level, as an estimation, this is the support. Now, what we want to see, any significant move that we can consider as a breakout, either to upside or to the downside. Here, retail traders saw rejection, and what they usually do is they sell short the resistance, their stop loss being above the last highs. In that case, they got stopped out of their positions. As usual, that's what happens when you don't understand price action and, most importantly, liquidity concepts. You need to think like a market maker instead of a retail trader. Now, if we quickly analyze how this price action has moved, it basically pushed aggressively to the upside, formed a small pullback, then continued breaking into swing higher highs. So we have a bullish break of structure, an indication that this market is bullish, which was then followed by a pullback, pullback that is still running at this point. And because this is an uptrend, confirmed with the bullish break of structure and higher highs with higher lows formations, we would expect that these previous lows should not break. So in other words, the market should form a higher low. These also being called as protected lows, or strong lows. These lows also have a demand zone. They both work together in confluence, with the price being currently right on the demand. So to see the price action more clear, we zoom into a lower time frame. So let's jump into the 15-minute time frame. The time frames you choose are not that relevant. What's important is that you zoom into a lower one, but there isn't a necessary or specific one. Here, for example, we see how the price approached the demand, took liquidity out of the past bearish candle with a wick, then quickly reversed back to the upside, with this last candle looking very bullish. So what we basically do is we refine the demand as being this one. The higher time frame demand was to confirm that it reacts positively, while the low time frame demand is the one that we're going to use for the trade entry itself. So positioning the setup, buy long on the demand, stop loss below the demand, take profit at around 1 to 3 since this is a more risky setup. We're essentially expecting that the market should probably go up either to create a lower high, in that case the high time frame might reverse into a downtrend, or create a higher high, case where the market will continue its high time frame uptrend. But with this setup positioning, we're covering both cases. And that was a quick and simple intraday setup. This works on crypto as well, but careful to stay mostly on high cap ones so they're harder markets to manipulate. We want markets where only market makers can easily move the markets. We don't want markets where any retail trader with some money can have a huge impact on the price, because that's when the price action will start to move more random. So anyway, we mark the support, being the level where many lows have bounced back to the upside. And we mark the resistance, level where many highs have rejected back to the downside. Now there's also a way to know which break is more likely to happen, and that is by looking at the trend previous to the consolidation. Here, for example, we've got a massive uptrend, so the more likely upcoming break is to the upside, because this entire move can be an upwards impulse, a consolidation to rebalance the liquidity, and continuation of the initial trend. But in the other scenario, the market can also break to the downside and reverse this trend, however it has lower chances to do so. So let's see what happens first, then we can continue with the planning. We've got the first case, so trend continuation is in the books. So we do the first thing, which is to mark the demand zone. And here something interesting happens. This is the valid demand, because it has an imbalance attached on the upside of the demand zone. When you see a demand, and next to it an imbalance is found, that's the highest quality demand you can find. So in this case, we don't need to increase the quality of the demand, and also this being a small demand zone, it means that the stop loss will be tight. So in other words, we can target a higher risk-reward ratio. We can also lower the time frame just to see the price action more clear and set the targets. However, the entry itself is still on the demand taken from the initial time frame. Let's jump one lower time frame, for example, the 15 minutes one. Alright, so let's do a quick analysis of what has happened. We've simply got a basic downtrend price action, an impulse to the downside, a pullback to the upside. The pullback ends on a supply zone, from where the market rejects back down into breaking below the past lows, so forming a bearish break of structure, then once again, pull back to the upside. The pullback moves into a supply, price rejects back down from the supply, and breaks into lower lows. Holding a new bearish break of structure, what we want to see if this demand would respect is a bounce from this demand, followed by a higher low, then a higher high, and this bullish price action to keep sustaining until our take profit. So we plan the setup. Buy long on the demand. Stop loss below the demand. And for the take profit, one smart choice of exit is right above these highs. Because as I said before, if the demand respects, then the demand will push the market to the upside. This will eventually form higher highs, which from a downtrend, the first formation of higher highs is a market structure shift. And because it's on the lower time frames, it's an internal shift. This shifts the low time frame trend into forming higher highs and higher lows, which would form a bullish market structure shift, but on the higher time frames. This being the first optimal exit level out from this trade. Pretty simple and straightforward setup. One last back test. We observe which swing levels have rejections. On the upside, this should be the resistance. Notice here how the market tried to push higher with many candles, but the wicks quickly rejected back down. Here it tried again, and here 2 times once again. Pretty clear, this is a resistance. Now on the downside, around here should be the support level, because notice this rejection. Here the market tried to break down, but the next candle came right back into the trading range, so another rejection. And here, once again, so pretty clear this is the support. Now we wait for a break of one of the levels. And here looks like the resistance has broken up, with very large buying pressure. So this market has pretty low chances that it will break back down into the trading range, since the breakout has continued with 2 more very bullish continuation candles. Here instead we might look for a retest of the broken resistance into a support, moment where we look for a demand zone to trade from, but to increase the chances and quality of the setup, we zoom into a lower time frame and look there for opportunities. On this time frame, we've only seen the most probable trending move, but the execution itself is done on the lower time frames. And here, because we're already in a pretty low time frame, being the 15 minutes one, I will zoom the most I can, so into the 1-minute chart. Now here it's what I said before, that we want to pull back into the broken resistance to retest it and flip it as a support. So we need to look at around this level and observe if there is any entry model on the left, entry model that works in confluence with our view. And some might have already seen a demand right here. So this is the level where we will try a setup planning. So buy long on the demand, stop loss below the demand. For the take profit, it's complicated here because we don't have any important exit levels. We need to wait some more to plan the exit. The market is pulling back just as expected. Of course, as such a breakout, the market has to calm down for a while. The order got filled right here. Now we need to think of the exit. Here the most optimal one is above these internal highs. We are essentially expecting a trend continuation, and this would form an internal market structure shift to eventually continue the uptrend with a bullish break of structure on the high time frames. And this might take a while. Wow, it even went higher, but I wouldn't have targeted more than this because even this is a pretty high risk-reward ratio. But in some cases, the price action is seamless and gives the opportunity for such setups. And don't forget, a very advanced lesson has been added on my program. And there will be many more, with the goal of building a team of as many profitable traders as we can. Learn more on the link in the description, or visit my website and see you in the next video.